Imagine standing at the edge of a vast, calm lake with a single pebble in your hand, knowing that dropping it now will create ripples that reach the farthest shores by tomorrow. In the landscape of your financial life, that pebble is the first dollar you set aside today, and the ripples are the exponential growth it can achieve over decades. Many ambitious professionals delay this simple action, waiting for a moment when they feel perfectly established, only to realize later that time was their most valuable asset. The truth is, the most profound wealth is rarely built through sudden windfalls, but rather through the quiet, relentless math of starting right now. At the heart of this relentless math is compound interest, a financial force so powerful it is often playfully called the eighth wonder of the world. When you invest money, it earns a return, and in the following years, those returns begin earning their own returns. It is essentially your money working tirelessly on your behalf, creating a snowball effect that starts small but eventually gathers massive momentum. Understanding this mechanic shifts your perspective from merely saving cash to actively cultivating a growing ecosystem of wealth. Unlocking that momentum requires one critical ingredient that you can never buy back once it is gone, and that is time. An early investment strategy capitalizes on a long horizon, allowing your initial contributions to cycle through decades of growth, market recoveries, and dividend reinvestments. By beginning in your 20s or early 30s, you give your portfolio the runway it needs to multiply significantly, reducing the heavy lifting you would otherwise have to do later in life. You are effectively hiring time to do the hardest work for you. Consider two different approaches to the exact same finish line. Sarah begins investing $300 a month at age 25, stopping completely at age 35, while David waits until age 35 to begin investing that same amount, but he continues every single month until age 65. Despite contributing for 30 years compared to Sarah's 10, David will likely end up with less money at retirement, assuming the same average market return. The dramatic difference in their final balances is entirely due to the head start Sarah gave her money. That 10-year head start allowed Sarah's early contributions to compound uninterrupted for 4 decades. The true magic happens in those later years, when the annual growth on the account begins to exceed the total amount of money originally contributed. This is the inflection point where your portfolio takes on a life of its own, generating returns that can eventually replace your working income. It proves that when it comes to securing your future, when you start matters far more than how much you start with. To maximize this growth, you need the right environment, and one of the most effective tools available is the Roth IRA. This specific type of retirement account allows you to contribute money that has already been taxed, meaning your investments grow completely tax-free over the long haul. When you finally withdraw those funds in retirement, you will not owe a single dime in taxes on the earnings, which is a massive advantage after decades of compounding. It is a powerful shield against future tax liabilities. Taking advantage of that tax-free growth requires a deliberate shift in your monthly cash flow. You can begin by setting up an automatic transfer from your checking account to your Roth IRA the day after your paycheck arrives, treating it as a non-negotiable bill you pay to your future self. Even contributing $50 a month establishes the habit and sets the compounding engine in motion. As your income grows, you can gradually increase that contribution until you reach the annual limit set by the IRS. A frequent stumbling block on this journey is the illusion that you must be entirely debt-free or earning a high salary before you can afford to invest. This perfectionist mindset often leads to years of missed opportunities, as life will always present immediate expenses that demand your attention. Waiting for a flawless financial landscape means sacrificing the most potent years of growth your money could ever experience. The goal is to start messy, start small, but absolutely start today. Beyond individual accounts, your workplace likely offers another cornerstone for your financial foundation, commonly known as a 401k. This employer-sponsored plan allows you to route a portion of your pre-tax salary directly into the market, lowering your current taxable income while simultaneously building your nest egg. Because the money is deducted before it ever hits your bank account, it removes the temptation to spend it, making consistent investing virtually effortless. It is one of the most efficient pathways to building long-term stability. The most compelling feature of many workplace plans is the employer match, which is arguably the closest thing to free money you will ever encounter in your financial life. If your company offers to match your contributions up to a certain percentage of your salary, capturing that full amount should be your highest priority. Failing to contribute enough to get the match is essentially leaving a portion of your compensation on the table every single year. That matched money immediately doubles your initial investment, supercharging the compounding process from day one. It is completely natural to feel a sense of hesitation when funneling your hard earned cash into accounts you cannot freely access for decades. This psychological friction often deters young professionals who worry about locking up their liquidity while navigating major life transitions like buying a home or starting a family. However, reframing this restriction as a protective barrier against your own impulse spending changes the narrative entirely. These accounts are not prisons for your money, they are dedicated greenhouses designed to protect your wealth from the elements until it is fully mature. Over the span of a 30 or 40-year career, these dedicated greenhouses evolve into formidable wealth building engines. Consistent contributions to a 401k and a Roth IRA, fueled by the relentless mechanics of compound growth, transform ordinary incomes into extraordinary security. The ultimate objective is not just to have a large number on a screen, but to buy back your time and autonomy in the later chapters of your life. This is how generational poverty is broken and lasting financial independence is forged. Of course, simply opening these accounts is only the first step. You must also decide how the money inside them is put to work. This brings us to asset allocation, which is the strategy of dividing your investments among different categories, such as stocks and bonds, based on your age and risk tolerance. A younger investor can afford a higher concentration in stocks, which offer greater growth potential but come with more volatility. As you approach retirement, that mix typically shifts toward more stable, income producing assets to preserve the wealth you have built. Woven deeply into your asset allocation is the critical principle of diversification, a method of managing risk by spreading your money across a wide variety of investments. Instead of trying to pick a few winning companies, you might purchase an ETF or exchange traded fund, which holds tiny pieces of hundreds or even thousands of different businesses. If one sector of the economy struggles, the success of other sectors can help balance out the losses, smoothing your overall ride. It is the financial equivalent of not putting all your eggs in one basket. Implementing that diversified strategy is easiest when you remove human emotion from the equation entirely through automation. By setting your accounts to automatically purchase broadly diversified funds every time you get paid, you bypass the temptation to time the market or react to alarming news headlines. This systemic approach ensures you are buying shares consistently, acquiring more when prices are low and fewer when prices are high, a practice known as dollar cost averaging. Automation turns discipline into a default setting rather than a daily struggle. There is a persistent myth that investing is an exclusive club reserved for the wealthy, requiring complex charts, insider knowledge, and massive sums of capital. The reality is that modern financial tools have democratized access to the markets, allowing anyone with a smartphone and a few spare dollars to participate in global economic growth. You do not need to be a financial expert to succeed. You simply need a basic understanding of index funds and the patience to let time do its work. Wealth is not a prerequisite for investing. Investing is the prerequisite for wealth. As your portfolio grows, you will inevitably encounter periods of economic turbulence where the broader market experiences sharp declines. These fluctuations are a normal, expected feature of the financial system, not a flaw, and they reflect the constant repricing of assets based on global events and corporate earnings. While watching your account balance drop can be deeply unsettling, it is crucial to remember that a loss is only realized if you choose to sell your investments during a downturn. Over a timeline of decades, the stock market has historically recovered from every single crash, continuing its upward trajectory. Navigating those turbulent waters requires emotional resilience and a steadfast refusal to succumb to FOMO, or the fear of missing out on the latest speculative trend. When markets are booming, you will inevitably hear stories of people getting rich overnight on risky bets, which can make your steady, diversified approach feel painfully slow. Chasing those fleeting anomalies often leads to devastating losses, derailing years of disciplined saving. True financial fortitude means staying in your lane, trusting your established strategy, and ignoring the noise of the crowd. If you are further along in your career and feel you have missed the early compounding window, it is imperative to shift your focus from regret to immediate, aggressive action. Mid career professionals often enter their peak earning years, providing a unique opportunity to drastically increase savings rates and direct substantial cash flow toward their portfolios. By auditing your expenses and aggressively funding your retirement accounts now, you can still build a robust safety net. The best time to plant a tree was 20 years ago, but the second best time is today. To aid in this accelerated effort, the tax code provides a specific lifeline for older investors known as catch-up contributions. Once you reach age 50, the IRS allows you to contribute additional funds to your 401k and IRA above the standard annual limits. This feature is specifically designed to help you turbocharge your savings in the critical decade leading up to retirement, allowing you to rapidly close the gap if you started late. Leveraging this benefit can dramatically improve your final financial standing. Whether you started at 25 or 45, the ultimate destination of this journey is a state of true financial independence. This is the profound milestone where your accumulated assets generate enough passive income to cover your living expenses indefinitely, untethering you from the necessity of a traditional paycheck. Retirement planning is not just about preparing to stop working at age 65, it is about reaching a point where work becomes a choice rather than an obligation. That freedom is the highest dividend your investments will ever pay. Reaching that milestone requires you to treat your financial plan as a living document, one that adapts to the shifting seasons of your life. When major events occur, like purchasing a home, welcoming a child, or receiving a significant promotion, you must recalibrate your savings goals and risk tolerance accordingly. Sitting down annually to review your asset allocation, increase your automated contributions, and check your progress ensures you remain on the optimal path. Regular maintenance prevents small deviations from becoming major detours. The secondary benefit of this consistent maintenance is a deep, abiding peace of mind that permeates every other aspect of your life. When you know your future is actively being funded, the daily anxieties surrounding money begin to dissipate, allowing you to make career and life choices from a place of abundance rather than scarcity. You stop worrying about surviving your later years and start dreaming about how you want to spend them. A solid financial foundation does not just secure your future, it radically improves your present. The reward for embracing these principles is a life insulated against the unpredictable shocks of the global economy. By harnessing the silent compounding power of the market, you transform small, disciplined sacrifices today into monumental security tomorrow. Those early lessons in diversification and tax-advantaged accounts will continue to bear fruit long after you have stopped actively managing them. It is the ultimate realization that wealth is built not by timing the market, but by time in the market. Your financial journey is entirely in your hands, and the tools to shape it are readily available to anyone willing to take the first step. By starting early, investing consistently, and trusting the math of compound growth, you are constructing a bridge to a future defined by choice and autonomy. Do not let the fear of imperfection delay your progress for another day. Take action, fund your future, and watch as time transforms your initial efforts into a legacy of lasting wealth.